Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets, the news that moves the markets, and the Rob that's joining me for the third week in a row. Hi, Rob. Welcome
Hey,
back.
Miles.
Yeah, I just can't get enough. We keep talking during this, we'll call it the doldrums summer of gold and all markets. Little feistier over in the equities market, only not the direction we want to see it going. But gold also coming into the bottom end of this enormous trading range that we've been in. So where do we go from here? Do we see our reversal? Do we continue down?
I think you're going to be looking at the commitment of traders like we talked about earlier today when we were prepping for the program. I am cautiously optimistic. We have breached 1700. And we are approaching that magic number of 1685. We're just a few dollars away from that. My guess is somebody's going to get ahead of this trade. We've seen the alignment of the Fibonacci numbers, which we have been pointing to for the last few weeks in this 1685, 1690 range. So if I was to guess, next week's FOMC meeting, they will raise rates again. Inflation is higher than what they had predicted. So they're going to stay the course, raise rates again. And it's possible that gold could actually trend down from here. But it's been a slow, steady decline ever since the spike from Ukraine invasion hit the gold market to the upside. We've been grinding our way lower, down to the point that you have been bringing up consistently. Here we are. My guess is if anybody is waiting for that magic number, take half your money or a third of your money, buy now, wait till next Wednesday, Thursday, and see what the consequences are. But my guess is somebody's going to get ahead of that trade and you'll see gold rising.
I'm glad you bring up the inflation because I know we talked about that pretty extensively last week with CPI up 15%, PPI up, 40%, I think was the numbers we looked at. And inflation, not only over 9% now, but increasing month to month was even higher. The increase in inflation was higher than anticipated. So with the expectation of increased price rises, now it's going to be some up and down. I know my local gas station is a little cheaper than it was a few weeks ago, but you are going to have panic moves up and panic moves down, and you really need to take the hot iron to those charts and kind of straighten them out and just look for the long-term trends there. So I definitely agree. I would expect to see an interest rate rise next week, and I think you're correct. I think we're seeing the metals and the equities market pre-planning those trades.
Yeah, I think this is in anticipation. I really do.
Right. Now we're seeing them do different things here too. The equities market is now up about 7% from the bottom back on, I think, June 14th. The Dow Jones is up a fair chunk while gold has continued to go down.
Yeah, and I agree. Gold has been steadily declining ever since the Ukraine invasion, but we're only down 6% for the year.
Right.
So gold is not a worry. We have not turned bearish. 5 years from now, we won't remember if we paid $18.20 or $17.20 or $16.80. We just won't remember. It won't matter. We know where we're going.
Right, and gold did move first. I mean, we had a good chunk of the gold move up between about 2016 and 2020, and it wasn't until a couple years later after the big inflationary COVID push that we're now starting to see some of the other commodities play catch up to what gold had already done. So it's very likely that you're not going to see these things move in tandem. They're going to move in cycles. And gold does tend to be pretty emotional and pretty reactionary to market sentiment. So with the expectation of rising interest rates next week, a declining gold price leading into it, and a rising Dow and rising S&P leading into it, there's a chance we may see a reversal in both, and that's going to look strong for gold with the expectation of concern, and terrible for the equities with the expectation of no more free money, and the free money is just going to stay gone.
Yeah, and it's counterintuitive why are stocks rallying in light of a 75 to 100 basis point raising of interest rates by the Fed. If we're in inflationary times, it's reasonable for our clients to expect gold to respond to that, and I think it will. Now, what is the commitment of traders? Let's go there, because I'm curious as to what the producers, the gold miners themselves, what is their position and how do you read that?
Right, and it's good to understand what does it mean too. So quick crash course on the commitment of traders. The reason I like looking at the producers column on the commitment of traders is because the producers use futures and options contracts to offset their existing supply or their existing mining capacity. So for instance, as say a gold firm that sells gold bars, let's say they've got $10 million worth of gold bars in their vault, they're going to own, if they're a responsible dealer who isn't gambling on the price of their own inventory, they're going to use the futures and options market on the short side to offset any potential losses on their physical product they own.
Which is what we do here.
Exactly. So if we own $10 million worth of gold in our vault, we're going to own $10 million worth of short contracts.
Correct.
So if gold goes up, we didn't make any money, and if gold goes down, we don't lose any money. Well, the producers do the same thing. So you would assume that producers are always short because they have inventory offsetting those shorts on the other side. So the question is not so much are the producers short or long, but how short. Now, there have been one or two times in my career here where they've gone long. We're talking like 2007 before the big market crash, and gold is $10.50, and there's no point in them selling gold at $10.50 because it's above their cost of production. So right now, the producers line in the COT from last week, they're at about 2-to-1, 56,000 short contracts to 27,000 long contracts. Now, that's a pretty aggressively long position for people who are sitting on millions of dollars worth of mining production. So the producers think that we're near market bottom, if not at market bottom. We're not quite at the point where we're below cost of production, because if we were below cost of production, they'd be 1-to-1, because why wouldn't they be? Or they'd just shut the mines down. But we're pretty close to cost of production, which is as cheap as you can really get in a commodity. But what is also interesting is the managed money category is 1-to-1, so they're starting to shift back along. And your other reportables category is like 4.5 or 5-to-1 long. So everybody over the last few weeks is now starting to shift more towards a long position on their commitment to traders. Now, this is last week's numbers. They come out a week in arrears, so I'll be interested to see this week's numbers next week. But money that puts a lot into this market is starting to lean long again. So we've got the commitment to traders report that's saying long. We've got coming into short, medium, and long-term fib numbers that all say long. A bottom of a massive trading range that all says very likely reversal. In the shorter term, like a 4-hour chart on both gold and silver, you see RSI divergence, which is telling us we should at least have a short-term reversal here. Now, it doesn't mean a trend change. It could, but at least a short-term reversal here. And we've got an expected interest rate rise next week. So I'm guessing, I hate to be a betting man in here because that's not the purpose of buying gold, but I'm guessing you might be right, Rob. We may see a little bit of a reversal next week.
I certainly believe that, and we'll just wait and see. And for all our listeners who have been commenting, hey, suddenly you guys are bearish on gold, we are not. We are just waiting for these numbers to line up, and they are now.
I'm just bearish on the purchasing power of the U.S. dollar.
Yeah.
And I'm just going to keep accumulating gold year after year for the rest of my life if I have to, as long as I remain bearish on the U.S. dollar.
Well, why else would you be in gold? It's not like we're waiting for the zombie apocalypse. We're in gold because it is capital, because we do not trust the current system or our leadership. I think I'm going to go buy some gold now.
Yeah, it's not a bad idea. I mean, we are like $5 away from, if not the bottom, a very, very easily argued step on the way down. So that's going to do it this week for Golden Rule Radio. As always, we encourage you, give us a call. We're happy, anybody here at McIlvaney ICA, happy to talk with you about your personal portfolio, your precious metals positions, making sure that you're organizing your precious metals holdings in a way that makes sense going forward, based not just on the dollar price or dollar value of gold, but even the relative value, the ratio trading strategies that we didn't talk about today, but have in many shows in the past. So definitely touch base with Rob or myself or any of the other advisors here at McIlvaney ICA. You can reach us at 800-525-9556. You can also find more info on Twitter at ICA Gold or Facebook at McIlvaney Financial. Thanks for listening and have a great week.